Alright, so for our final video lecture to conclude lesson 16, we're going to talk about exchange rates. And we're talking about exchange rates obviously because we're talking about international trade and keeping track of all of this trade on our balance of payments. Now obviously not every country uses the dollar, and so whenever we are going to engage in trade with other countries, before we make these transactions, we first have to account for the fact that we may be dealing in a different currency. So an exchange rate is nothing more than a rate at which two currencies are exchanged. You can also think of an exchange rate as the price of one currency in terms of another. So for example, up until just a couple of weeks ago, this was the rough exchange rate between the US dollar and the British pound. That's a fancy looking L symbol there. So if you were trying to, maybe plan a trip to the UK, you could go and for every $1.50 you handed over at the bank or the currency exchange counter, you would receive 1 British pound. Alternatively, if someone from the UK at the time was wanting to purchase something from America or come to spend money in America, for every £1 that they handed over, they would receive in exchange $1.50. So normally we think of prices in terms of the number of dollars that we have to pay for a good or service. So maybe a candy bar costs $1.50, right? So $1.50 in exchange for instead of a pound, you could think of it as a candy bar or a cookie or something. All right, so it's a little weird to think about buying and selling currency, but at the end of the day, all we're doing is exchanging one currency for another. Now, obviously exchange rates change over time. And so anytime an exchange rate changes, what we're going to see is that the value of one of the currencies is going to rise, or what we call appreciate in value. And if one currency appreciates, that means that the other currency must be losing value or depreciating. So another example from recently, in the wake of the UK vote on whether to stay or leave the European Union, what we saw is that there was a big drop in the exchange rate, literally overnight, and so it went from about $1.50 for every British pound to roughly $1.35 for every 1 British pound. So something like this. So it used to be that if you wanted to exchange your dollars for a pound, for every pound you wanted to buy, you'd have to pay $1.50. But then after the vote, what happened is now that same pound would only cost you $1.35. So what we're saying here is that the pound, by being now worth less in terms of dollars, has actually lost value. Right? A pound used to be worth $1.50, and now it's only worth $1.35. So the pound has lost value. That means it has depreciated. What that also means is that the US dollar has appreciated, right? You can think of it as almost gaining purchasing power against the British pound, because where it used to cost you $1.50 to buy that pound, now it only costs you $1.35 to buy the same pound, which means you have an extra, 15 cents left over, which you could then use to buy a little bit more of a British pound. So the dollar in this case has gained value, it's appreciated, it has become stronger, whereas the British pound has lost value, it has depreciated, it has become weaker. Now, the question then is, how is this change in the exchange rate going to affect the amount of trade that's occurring between these two countries? So we're going to stick with this example, the British pound versus the US dollar. Well, from the American perspective, again, we went from $1.50 to $1.35. So that means that with the same number of dollars, we can actually get more pounds in exchange. So if you had $3 before, you could get 2 pounds. And now with that same $3, you can get 2 pounds and some extra pennies of a pound, right? So what this means for Americans is that with a stronger dollar, we will actually be able to acquire more British pounds, which means we will be able to buy more British goods and services. In other words, we are going to import more British goods and services, which means they're going to be exporting more. Okay? Now that's only one half of the equation, because at the same time that our currency has grown stronger and increased our imports, the British pound has become weaker. So now the people in Britain, their pound was worth $1.50, and now their pound is only worth $1.35, which means with the same number of pounds they will be able to get fewer dollars, which means they will purchase fewer American goods and services. And so what this means is that while we as Americans are importing more from the Brits because of our stronger dollar, we are exporting less to the Brits, the people in the UK, because their currency is weaker. So on the American side, we import more, but we export less. So overall, our trade balance is going to actually decrease. We're going to see a decrease in our net exports. On the other side of the ocean, with the weaker pound, since they will be selling more stuff to us, so they're exporting more, but they're buying less American goods and services, so they're importing less. What this means is that their net exports will actually increase. So it seems kind of counterintuitive to think about a currency losing value actually being a good thing, but in this case, again, we went from just $1.50 to $1.35 per pound. The pound lost value, but the result for the trade between the two countries is that it actually boosts the British economy because their goods and services are relatively cheaper now. American goods and services are relatively more expensive. And so that'll be the case between any two countries. Every time that a currency appreciates, it's going to have a negative effect on the trade. The net exports will fall. And conversely, anytime a currency depreciates, it will actually boost net exports. Now, there are different types of exchange rates, and different countries will, set a different system or follow a different plan. And the two main types of exchange rates are what we call a fixed exchange rate and a flexible exchange rate. Now, a fixed exchange rate is set by that country's government. So that country's government issues the currency, and then it says, our currency is going to be worth some fixed amount relative to every other currency out there. And what's going to happen is that if the exchange rate deviates from that set amount, then the government itself that set that rate will dip into its official reserves. And recall, our official reserves are government holdings of foreign currencies, right? So, for example, if the United Kingdom government decided, oh, we don't like that weaker pound, they could dip into their official reserves and start buying up their own pound, right? They could use dollars or euros or some other currency to get into the currency market and start buying back its own pound, which would increase demand for the pound, which would then cause its value to rise. Now, in opposition to that, or a different type of exchange rate, would be what we call a flexible exchange rate. And what this means is that a government will issue its currency, and then it is going to let the market determine the exchange rate of that currency and all others. So, for example, the United States government issues the currency, but then allows buyers and sellers of the American dollar to determine what the value of the U.S. dollar will be in the international economy. Because if you think about it, the U.S. government issues coins and dollars, right? And we use coins and dollars, we use American currency in the United States to buy American goods and services. But that doesn't mean that dollars are only staying inside the United States, right? When we import goods and services, we may pay the foreign company in dollars, which means we're going to be sending dollars out. Or maybe someone comes to this country and works and then sends dollars back home in the form of remittances. So what we're going to see is that even though it's only one government that's issuing that currency, at the end of the day, the currency itself is going to be spread throughout the entire world. And so there's going to be people around the world trying to buy and sell dollars, trying to buy and sell euros and pesos and British pounds and every other currency out there, depending on what type of business or where they're trying to conduct business. So with a flexible exchange rate, again, the government will issue the currency, but then it allows the market, it allows just the natural supply and demand of the currency to determine its price or its exchange rate. Now, in reality, it's hard to find a country that's going to be operating on a purely flexible system because usually there's kind of a comfort zone. So as long as that exchange rate is fluctuating, it doesn't get too high or too low, then the government that issues the currency will allow the market to determine the value. But again, if it gets too high or too low, then the government will start to act as if it's maintaining a fixed exchange rate. And so just like a country that has an absolute fixed exchange rate, it'll dip into its official reserves. It'll dip, so the United States government will dip into its official reserves, and it'll take euros and pounds and pesos, and it will go out and start trying to buy and sell the American dollar in international currency markets. And it's not in an effort to get it back to one fixed amount, one set rate. It's just to get it back into some kind of comfort zone. So as long as it doesn't get too high or too low, as long as it stays within those limits, then it's largely up to the market. Okay, and so we're trying to just get it back into a comfort zone. Now, the last question we're going to consider is, how does a country's monetary policy affect the value of its currency? Now, recall from our discussion of monetary policy that, for example, the Federal Reserve, the central bank of the United States, its monetary policy is effective through its ability to manipulate the supply of money. So when the Federal Reserve uses its required reserve ratio or its open market operations to conduct expansionary or contractionary monetary policy, we talked about how that's going to result in a change in the excess reserves on banks' balance sheets, which then will cause banks to either make more or fewer loans, thereby expanding or contracting the domestic money supply. Now, as we said just a few minutes ago, dollars, once they are created, once they are spent, amongst private individuals and firms and businesses, some of those dollars may end up, outside of the United States. What that means is that in international currency markets, the supply of dollars that's available throughout the entire world is going to be tied to the supply of dollars that are available within the United States, that are the domestic money supply. So what this means then is when the Federal Reserve conducts monetary policy, it's not just expanding or contracting the domestic money supply, it's also going to be expanding or contracting the supply of dollars around the entire world. So for example, let's say the Federal Reserve determines that unemployment is becoming a problem. Well, we know that to fight unemployment, we conduct expansionary policy. Now, there's expansionary fiscal policy, right, spending and taxation, but we're thinking about just monetary policy here. So if we do expansionary monetary policy, we'll lower the required reserve ratio, we'll buy bonds, we'll lower the discount rate. Any one of those actions is going to lead to an increase in the money supply domestically, which will help drive interest rates down and start to encourage more spending. But what's also going to happen is that the supply of dollars in the rest of the world will also be increased, because if there's more dollars in the United States, there's going to be more dollars floating around everywhere. And from our basic model of a market, you can recall that anytime there's a greater supply of something, what happens to its price? Well, it goes down. And in this case, with a greater supply of dollars out in the rest of the world, that means that the value of the dollar is going to decrease. In other words, the dollar will depreciate, not because of any natural, changes in the market for the dollar, but simply because the Federal Reserve, through its expansionary policy, has increased the supply of the dollar, thereby driving the value of the dollar down. Now, that might sound like a bad thing, but again, remember, what happens to our international trade when our currency weakens? Well, in the example before, when we said that the dollar appreciated, right, the dollar is now stronger relative to the pound, we said that that would actually be bad for our net exports. But what if we went in the opposite direction? What if it was not moving this direction, but the opposite direction? So now the pound is actually appreciating, which would mean if we went from $1.35 to $1.50, that means the dollar is depreciating. So with expansionary monetary policy, we see a depreciation of the US dollar. And what that's going to mean is that our American goods and services will be relatively cheaper for other people in other countries. So they'll start buying more of our goods and services. So our exports will increase. But simultaneously, those foreign goods and services are now going to be relatively more expensive due to our weaker dollar, which means we will buy fewer foreign goods and services, which means we will be importing less. So with higher exports and lower imports, overall we'll see an increase in our net exports. And recall from our discussion of the ADAS model, if the net exports goes up, then we'll see an increase in aggregate demand. We'll see higher output, lower unemployment, but perhaps higher inflation. So at the end of the day, when we're tracking the current account balance, and we're seeing what effect the exchange rates have on our current account, or the effect that monetary policy has on our exchange rate, At the end of the day, we still can use our very simple ADAS model to predict what that will mean for the U.S. economy. And so we will go over some more examples of this together before the exam. And for now, that concludes the lecture.